Our first speaker here is Petra Bakosova. So just a quick intro. Petra is the Chief Operating Officer at Hull Tactical. Her background is in algorithmic trading across multiple asset classes, mathematical modeling, and risk management. She joined Hull Investments in 2014 and worked on projects for its proprietary trading firm, Ketchum Trading, before transferring to its quantitative asset management unit, HTAA. She holds a Master of Science degree in financial mathematics from the University of Chicago.
Thank you, Gus, and thanks everybody for attending my talk today. First of all, let me tell you how impressed I am that you guys are interested in listening to math talks at Saturday mornings and give up a beautiful Saturday morning such as this one. And if it doesn't seem as beautiful as it seems to me, keep in mind I just flew in from Chicago where it literally just stopped snowing last week, so this feels like summer for us, so I'm very excited to be here. And before we dive into the math, I feel like I should address the elephant in the room, and the elephant in the room being market timing. For those of you who are still at school, maybe it doesn't seem so controversial. For those of you who remember the 70s and 80s, you probably know that this has become sort of a taboo in the financial industry. Basically what happened, there was this very popular notion that people would predict when the market goes up and they would predict when the market falls down, and then for the rallies we would load up on stocks, we would leverage. For the bear markets we would go into cash and preserve the capital that way. The only problem with that was it never really worked, and it developed a horrible reputation along the way. Robert Merton referred to it as fool's errand, and Burton Malkiel warned his readers not to do it. He said it was dangerous, and nobody could do it. At the same time, the academic literature on return predictability has evolved in the last 20 years. So originally, I feel like the first school of thought on expected returns, it was expected returns are constant, and Gene Fama now calls that notion amateur hour. Now, then the second development are the expected returns are not constant, but they're also not predictable. And then more and more articles in the recent history that come out say that expected return are somewhat predictable. But the general consensus is that even though there is some predictability in expected returns, it's very difficult to build a robust strategy that would capture this predictability and turn it into a strategy that after all the transaction costs, after all the turnover, would produce any kind of consistent results. So this is kind of where we stand today, and full disclosure, I'm not here to claim that we have solved the problem and now we know how to predict the returns and how to build perfect models. But at the same time, we see tremendous opportunity with the explosion of data and with the explosion of predictive analytics in the recent years. So we decided to publish a lot of our research, and we're hoping to spur a discussion and spur more research into this topic. So we have published to this day 3 papers, and this talk will focus on the second of the 3 papers. I will briefly mention the other 2 papers later in my talk, but the main focus of this talk will be our paper called Return Predictability and Market-Timing, a 1-month model. So the presentation will be organized as follows. I will briefly describe the model, the variables, and the statistical model we built. I will discuss the results of this 1-month model and maybe the economic significance of these results. Then I will allude to the other 2 papers we published and discuss potential benefits of combining various market timing models. In the last part, I will briefly mention some of the other things we do. So what we also try to do, we try to keep our research real time, meaning that we keep updating all these models even after publication, and we created these daily reports to show how the models are doing and what they're predicting. So this is the abstract of the paper. It's available on SSRN for you to read. As you can tell from the title, we will be talking about 1 month excess market returns, or ERP, equity risk premium. I will use these two terms throughout the presentation, and they mean both the same thing. So when I refer to excess returns, I mean the S&P 500 returns minus the 3-month T-bill returns. So there's 15 variables that go into the model, and we use a weighted least square regression with a stepwise variable selection procedure. Trying to move this mouse. In the backtest between 2003 and 2017, we found that the strategy doubled the Sharpe ratio of buy and hold. So instead of achieving 0.46 Sharpe ratio, the strategy showed 0.92. In all our papers, we do adjust for transaction costs and trading costs, but we never take out any management fees, so just so to keep in mind. Then I will sort of diverge from the paper, because when we published this paper, sometimes in the summer of 2017, we only had one paper out. So the paper talks about the combination of the two models, but I will actually talk about combination of 3 models, because we have published one paper since. So these are the variables that go into the model, and unless I specify otherwise, for all these variables we used 1 month changes as the transformations of these variables. We also normalize them by their 500-day standard deviation. This doesn't affect the forecasts that the models make, but it gives interpretability to the coefficients of our model, so that helps us understand the variable importance. So I'll just go through them one by one to briefly explain what they are and what they're supposed to do. So the change in inflation, in some other academic work, you would see it as unexpected inflation. We use a 1 month change in inflation and subtract T-bills, and we expect it to have a positive correlation with forward 1 month returns. Then we use industrial production index from Alfred. And just a side note, in terms of data sources, for all the macro variables that we use Alfred, because Alfred has a revision history. And when we model our backtest, we try to use point-in-time data to avoid suffering from observations versus data revisions. Again, industrial production, we expect it to have a positive correlation with forward returns. And in terms of where we get the signs of the correlations from, pretty much every variable that we use, in order to sort of reduce the impact of data snooping, we only use variables that have existing research and have published articles about them. So typically, whatever the authors claim in the article, that's the sign that we stick to in order to limit some of the overfitting. So credit risk premium, you probably know the variable as the default spread. It's just the difference between BA and AAA corporate bonds. Slope of the interest rate term structure, also known as the term spread. It's the 10-year minus 3-month treasury rates. So for commodity prices proxy, we picked the GSCI, Goldman Sachs Commodity Index, as a proxy. This index is heavily skewed towards oil prices, and we're okay with that, because what we were sort of trying to model was the relationship between oil prices and S&P 500 returns, but we found enhancement in just not doing just oil prices, but sort of looking at different commodities. We also look at housing starts index from Alfred, which again is kind of a proxy for economic activity, and it's the early stages of construction cycle, so we also expect that to have a positive relationship with forward returns. We also looked at the exchange rate, and more specifically, we used the US dollar index from Bloomberg. The next two variables come from the same source, and they sound like substitutes, and later in the paper we will find that they sort of are substitutes for each other. So the Federal Reserve Board Loan Officer Survey, for those of you who are not familiar, they create these quarterly surveys when they send questionnaires to senior loan officers and ask them about, what their views are on the economy and whether or not they are tightening the credit lending conditions. And so the loan variable we will refer to is the percentage of banks that are tightening credit conditions. And then delinquencies is the annual change of the delinquencies rate. And we also use new orders, new shipments in this model. But what we do is we remove aircraft and defense spending from this metric. And we do that in order to sort of reduce the impact of government spending, because we're interested in seeing the real economic activity. Speaking of economic activity, we also use the Baltic Dry Index, which is a proxy for shipping prices around the world. On the same note, we use the National Association of Purchasing Manager surveys, and we look at two surveys in particular. We look at a new orders survey and prices paid indices. Then we also look at the unemployment rate, and just to keep it consistent, we just look at the 1 month change in unemployment rate. We also use a momentum indicator. The academic literature typically says that returns anywhere between 1 month and 12 months have a positive correlation with forward returns. We just stuck to 1 month, but it really wouldn't make much of a difference if we use like a 3-month return versus 1 month or a 12 month. And last but not least, we look at the valuations. So we look at 3 price ratios. One is CAPE, cyclically adjusted price to earnings. One is KD, cyclically adjusted total yield. And the total yield is the sum of dividends and buybacks. And then we look at price to book.
So, a lot of people use ISM. Is there a reason you guys don't use ISM?
I think that's what we refer to as NAPM. I think that's the same data source. Yeah.
And just so that for some context, is there any reason you guys picked up this?
So there's a couple things. So one was we wanted to avoid some of the same variables that we used in the 6 month. And then as a motivation, one of the models that sort of preceded this study was we were reading a paper by Northfield, and they published, they built all these different risk models, and a lot of these variables appeared in one of their risk models, so that was kind of the basis, and then we kept adding things to it, just thinking about like what is it that we're not looking at that might have impact for like a shorter term expected risk premium. So it's just how it started, the genesis of the project.
Anything obvious there that you thought you should be related and it wasn't?
So some of the shorter term, we had, for example, when we started, we had like a shorter term price reversal. So we were hoping that like the sub 1 month returns would have like a negative correlation, and it just never really materialized. So some of the more technical things you would think, but not really.
A question about this variable. How frequent does this variable update?
I'll talk about it.
Okay.
So here's what we capture the variables at their natural frequency. So a lot of them are quarterly, as I mentioned, the loan and delinquencies, and then a lot of these are monthly variables. And then so what we do, the way we fit the model, as I mentioned, it's going to be a weighted least square regression with a stepwise as a variable selection. In terms of weighting, we picked a decay of 0.99, which sort of results in a half-life of about 5 years. The model itself is pretty robust. I think in the paper we performed some robustness checks on this parameter, so it's not crucial to pick 60 months per se, but we liked the 5 year as a proxy for the kitchen economic cycle. In terms of the actual fitting, this is kind of the crucial part of what we do. So in this particular model, we want to use non-overlapping data. So we collect the data at their natural frequency, but at the end of every month, we sort of take a snapshot of what's the most recent value for each of these indicators. So for the fitting purposes, the data starts in 1990, and let's say we allocate the first 13 years as the first in sample. So we take data from 1990 through 2000 and through like 2003. Let's say we're stopped in January 2003. So we take these like monthly data, we make the initial fit on the model, and we store all the parameters. So we end up with a bunch of betas. And then what we do for the next month, we use the parameters that we fit in this first initial fit to create outsample forecasts for the next month. And even though we fit on monthly data, we make forecasts every day. So then when the data updates on different dates, our forecast will change throughout the month. And then at the end of the next month, we expand the in-sample to include the most recent month. We refit the model again using the bigger sample. Again, save the parameters, and then forecast for the next month ahead. So this is what we call, and I think this is what everybody else calls, walk-forward analysis. And what it achieves is, more traditionally, a lot of times when people talk about testing models, they have a training set and a test set. But the problem is if you have time series data and you want to allocate 80% of your data to training, if you have 20 years of data, so you train on first 16, and then you only have 4 years of outsample results. And it's really difficult to judge any strategy on 4 years of data, as you know, for obvious reasons. So this allows us to have a much longer outsample history, because even though we know what the history is when the model was fitted in every period, it never peeked ahead, so it never saw the data before it was fitted. And so this is the evolution of the variable selection procedure. These were all scaled, so these are not the actual coefficients, but it kind of shows the relative importance of each variable. So you can see some of these variables stay in the model throughout the time, and some of them alternate. So for example, Baltic dry is pretty prominent. That's this pink one. It stays in the model for the most part. And then I mentioned a little bit earlier the delinquencies and loan being a little bit of substitutes, and you can see the effect. So in the first part of the data, delinquencies played a big role, but then they were sort of replaced by loan, and they never really appear in the model at the same time. And then, so we start with 15 variables, and as you can see, for the most part, the model cuts it down to somewhere between like 4 and 8 variables in a given refit.
What criteria do you use to select them? You say it's
AIC.
AIC.
Mm-hmm. So for example, you can see in the beginning, Baltic dry was very important, commodity prices, credit risk premium, and delinquencies. And if you looked at most recent refits, for example, nowadays the model is mainly driven by the loan officer survey, price indicators, unexpected inflation, or unemployment rate. So it definitely does vary throughout the time. So for the most part, if academics write papers, they're more or less done at the previous slide, because they create some kind of forecast, and then they evaluate like an R-squared or certainty equivalent or some kind of accuracy metric, and it's the end of the story for them. For practitioners, this is only where the fun begins, because now if you create some forecasts, you have to decide how are you going to trade them. So in this paper, we propose a simple strategy where we take the forecast and multiply them by 5 and multiply it by inverse of the root mean squared error. So the root mean squared error, the reason why we do it is generally we want to bet in proportion to our confidence. So every time we refit the model, we get this metric, and the higher the root mean square error, the lower our confidence in the model is at that specific refit. So that multiplying it by the inverse of that sort of makes us make larger bets when we're more confident, and makes us make smaller bets when we're less confident. And then the multiplier of 5, that's a little bit arbitrary, and it mostly helps us achieve the position targets. So the position targets are as follows. So we want to be 0% invested in the S&P 500 when the forecast for the next month equity risk premium is less or equal to 0. There's 2 considerations why we don't want to go short. One is practical. Clients hate when you are short, and especially they hate when you are short and the market goes up. So there's not a lot of benefit to being short. It's very costly. They And then there's also some academic work that says any return predictability on the lower side is very difficult, if not impossible. So, and then we didn't see a lot of value in our negative forecast either. So we want to be 100% invested when the forecast is at its historical average. And this is, again, a consideration for us because we treat buy and hold as our benchmark. If we were a hedge fund and our benchmark was, we were aiming to build a zero beta product, this would be a very different story. But for us, we do want to compete with the buy and hold. And then we had to pick a maximum leverage. Again, two considerations. One is practical. Many retail clients do not have access to like a 3x, 4x leverage. So if we wanted to publish something that would be available to the public, we had to keep the leverage pretty low. And then on the other hand, we wanted to show some leverage because again, we're comparing it to the S&P 500. So we wanted to sort of create like a return risk profile that would sort of be in line somewhere with the risk and return of buy and hold.
What's the average turnover you see?
I will show you a plot of the signal. I don't have the turnover number, but it's pretty high. I would expect it to be somewhere at least 1,200% a year or something. So this is the wealth accumulation of the backtested results. And as the story goes, I've never seen a bad backtest, so keep that in mind. But that's kind of like what we would expect to see of a desirable market timing model, is a model that sort of smooths out some of the big drops in the market. You can see it gets flat in like 2008, which gives it a lot of its outperformance. And then it like smooths out some of the volatility in like 2012. What's kind of unique about this model relative to different market timing models is that it actually does okay in the market rally. And that's partially because it's allowed to have a little bit of leverage. So it's able to keep up with the market in like 2003 and 2015. So these are the performance statistics. I already briefly mentioned the Sharpe ratio. But the Sharpe ratio is not the only consideration when it comes to building trading strategies, especially building trading strategies that you may want to offer to clients. Obviously they pay you management fees, so if you build them a Sharpe 1 strategy, but it offers 1% return and 1% volatility, charging them 1% management fee kind of defeats the purpose. So that's partially why we picked certain scaling factors. But again, like all the performance is relative to scaling, but this is what it was in the white paper. We see that the strategy reduces the volatility of buy and hold actually from 18.4% to 16.6%, and it improves the annual return from 10% to almost 17%. What's important is that we wanted to see how much of the excess return just comes from levering up on market risk. So that's why we display the CAPM alpha and beta. And we see the strategy does not have beta over 1. So it's not that the excess return is coming just from like levering up on risk. The one metric I would like to talk about a little more is actually the max drawdown. There has been a lot of discussion lately about the value of money management industry and value of financial advisors and value of active managers. And kind of the consensus is that they don't generally deserve their fees. And I think a lot of it is very valid. But the one thing that this discussion largely omits is I think there's a lot of value in the money management industry, not necessarily from improving the returns over passive indexes, but from making people not jump off the ledge when the things turn bad. So I think a lot of the value money managers add is not necessarily give their clients a 1% excess return, but making sure that their clients do not sell when they suffer a 50% drawdown. And the one way to sort of help your clients not to panic and not to give up is give them strategies that reduce drawdowns. So this is definitely one of the goals that we always are mindful of when we build strategies. So we'll see that, so for the 1 month model, even though the buy and hold suffered a 55.2% drawdown, this strategy only suffers a 20% drawdown. And to sort of answer your question before about the turnover, so this is the time series of the signal. So you can see the signal actually moves around a lot. Especially in the first period, it oscillated quite a bit between 0 and 150. Then it sort of like stayed at 0. And then you can see in like 2013 through 2015, it was largely leveraged. And now it's back to sort of oscillating again.
This is trading the S&P 500. What's the vehicle? Is it ETF or is it futures?
So you can do either one. So you can do the SPY ETF or you can trade futures, whatever you have access to. So I already talked a little bit about drawdowns, saying that it's important to reduce them, but it's also important to have them ideally at different time at the broad market. So if you want to add value to your client's portfolio, it's great to reduce the drawdowns, but you can further add value to make them suffer less when they already suffer in the rest of their portfolio. And that's what we see in this model. The largest drawdowns actually occur in like end of 2010, 2011, when the market's already recovering. So, during the worst period of 2008, 2009, this strategy would have done pretty well. I also showed a rolling outperformance of this model. This is a 1-year rolling outperformance. So essentially, whenever the line is above 0, it means that over the last 12 months, the model has returned more than the S&P 500, and whenever the line is below 0, it means it returned less. So what you would typically expect in the market timing model is that you would see like a big outperformance in the financial crisis, but then you would see a huge drop and you would just see it like a trailing at all the bull markets. And this model is a little better than most, saying that yes, it does underperform in the recovery periods, but then it shows a certain ability to perform well even in bull markets. So I think I have about 10 minutes left, so I'll try to speed through this. So this was kind of the conclusions on the 1-month model. But then we also published 2 papers, and we wanted to start a little bit of discussion about why and whether we should be combining different models. And this is sort of like a theoretical background about why. And because this is a conference hosted by Quantopian, it seems a little redundant to try to explain why we should be combining multiple strategy to a company that sort of built their asset management business on combining multiple strategies. So I'll keep it short, and if you want to talk about value of ensembling, just ask every Quantopian person here. But generally speaking, the short story is it's difficult to know which strategy is the best because we have short track records, we have a lot of parameter uncertainty, we can't really know how overfit the models are, and there's diversification benefits from combining models, so that's why we do it. So this is just a very quickly, again, this is the first paper we published, A Practitioner's Defense of Return Predictability. Again, this was a 6-month model. These were the key factors. You will see some of them overlap with the 1-month model, but with the 1-month model, we're sort of focusing on the 1-month changes, and these are kind of like the more like longer-term moving values. So you remember, there was the inflation was there, default spread was there, loan officer, Baltic Dry, price ratios, but there's some variables that are unique to this paper, such as the consumption, assets, and income residual, variance risk premium, implied correlations or short interest. And the statistical model was slightly different in this paper. It used an ordinary least squared regression with like a 12-year look-back period. Again, the 12-year was picked to mimic an economic cycle, but the model was pretty robust. The big difference was that when we introduced this model, this was the first paper we wrote, and we were using overlapping data in the model. So the impact this had was if you use overlapping data in regressions, all your t-stats and all your p-values are useless because they've been inflated. So we couldn't use any of the traditional variable selection techniques, so we used correlation screening instead. So in every refit, we actually looked at correlation of individual predictors with the forward 6-month ERP and only included a subset that had a high enough correlation in that specific period. Again, we did monthly refits of this model and daily signals. And then the most recent paper we just published, it went up on SSRN last week, so it's brand new, called Seasonal Effects on Other Anomalies. This was a different model in a sense that there was not, we did not build any regression using these anomalies. It was purely deterministic in a sense that we just developed simple univariate strategies with a number of different anomalies and then discussed how to combine them. I did a webinar with Quantopian about a month ago about this model, so if you're interested in the seasonal effects and how we use them, feel free to check out the webinar. So this is the performance of the combined of the individual strategies and the combined models. So the first three columns, the first one is the seasonal and trend model, then the 6 month and the 1 month. The numbers are slightly different because now I expanded the backtest to go through end of 2017 for all models. So that's why the 1 month performance statistic changed a little bit. But you know, when you look at, and then the next two columns are the combination. So the first one is just a combination of 1 month and 6 month. And then the fifth column, that's not a typo. I actually did divide it by 2. So instead of adding the seasonal and trend as like a 1/3, 1/3, 1/3, I just added as an overlay. And I did that just to keep sort of the volatilities in the same range, because you can see the SATM model has a really low return and volatility. So if I just did like the 30, 30, 30, it would sort of like shrink the entire performance, so it wouldn't be as obvious as a comparison between the two and then relative to buy and hold. But the moral of the story is that if you look at the individual Sharpe ratios, they range between 0.94 and 1.09. But if you combine the two models, you get a Sharpe ratio of 0.118, and all three resulted in a 0.126. So it definitely some diversification effect from combining these models. There's not much to talk about in terms of returns because they're just weighted averages of the individual returns. But there's, you know, if you look at some other metrics, for example, time underwater, you can see you can definitely reduce, you know, between the 6 month and 1 month, the combination of the two reduces the time underwater further. And in terms of drawdowns, just when you combine the two, the 1 month and 6 month, even though each of them have about 20% max drawdowns, the combined max drawdowns are less than 15%. So it definitely helps with the drawdowns. And again, we show the CAPM alpha and beta to sort of show how much of the performance is related to just loading up on market risk. I think the last chart I'll show is just again, zooming in on the drawdowns a little bit. So the reason why the drawdowns were reduced by using these models is that the max drawdowns of the individual strategies do not occur at the same time. So the max drawdown of the 6 month model occurred in like 2008, but for the 1 month it was way later. So as a combination, you kind of get this like smoother wealth curve. So I spoke about a daily report. So we published this on our website, and you can subscribe to it. So if you want to keep tracking these models and see what they're forecasting, you can do that. And we also have an archive. So we're trying to be honest, and we're trying to like build an actual live track record, because we think like as much as we try to use like unrevised data, and as much as we try not to overfit the models, and as much as we try to like build some robust walk forward, we can never remove all the biases. So instead, we're trying to build like a real-time track record and store all the forecasts so that a couple years from now, we can have some kind of objective evaluation about whether or not these models work. So that's the website where you can find the reports, and we also show some performance there. We have a blog. You can follow us to keep in touch with our research. And with that, I would like to thank my colleagues Alex, Rick, and Blair for the data inputs. And if there are no more questions, I will open the forum to, if there are no, well, I'll open the forum to questions. Probably. So we haven't done much work in like NASDAQ or Russell because they are so highly correlated, so we felt like we wouldn't really learn as much. But the other direction is like how much could we use this for less correlated asset classes? So could you do something similar for commodities, or could you do something similar for international equities, or fixed income? And that's partially what we're working on now. We've done some research on volatility, and there's some value. Obviously some variables would be more suited for US equities, so it kind of comes to like what variables you're using. But some of the more technical factors have definitely showed values across different asset classes. Yeah, it's all work in progress. So we're a pretty small group. We started in 2013. You see some of this work was just published this year, so everything's on the to-do list, but the to-do list is like way longer than the amount of time we have. So yes, we want to look at different sectors, and we want to expand from like a 2-asset problem into like a 3- and 4-asset problem, but it's all in the works. So we've had little bit of success with nonlinear, but only with very short horizons. So when we fit like 1-day or 1-week models, we have seen some value in like KNN models or like GBM. But in these like 1 month and longer, the problem is you have so little data, and anything nonlinear tends to be so data greedy. It's just like you get an excellent model in sample and 0 value out sample. Yeah, that's kind of related to like what's the left-hand side, and to be honest, we have not. But if this holds, it should hold. So if you want to help us with the research and try it, that would be great. So yes, and it depends. So like we've done a couple things. So like we tried removing the 2008 and 2009 as a whole, just removing everything. But then the problem, and you will see, because when I plotted the outperformance, you lose a lot of the outperformance, because a lot of the outperformance comes from 2008 and 2009. But then when you saw like the later period, from like 2012 to present, there was still some outperformance. And the outperformance in the recent history has nothing to do with the credit, because like the credit didn't really offer a lot of useful information. Yeah, and then we've removed the factors. And the model was pretty robust to like having individual factors removed, but at one point, like once you remove everything, then it kind of like the performance kind of goes down as we would expect. But it's not like if you remove this one variable, like everything just falls apart. So for the RMSE, not very. So the RMSE between the different refits is actually, it varies a little bit, but it's not a huge thing. And then in terms of the performance and the multiplier and the leverage, so the Sharpe ratio is relatively invariant. It's not invariant because like once you start hitting the boundaries a lot, and the more you hit the boundaries, that affects your Sharpe ratio. But generally speaking, Sharpe ratio is relatively invariant to scaling. So what really then changes is like the return on volatility. So the model sort of drops it off because it uses this like weighted least squares. And then the 6-month the 6-month model does it explicitly. So the 6-month has a 12-year look back. And there's always a debate, because on one hand, you don't want to have the old data very important because you say like, oh, this is not as relevant. But on the other hand, if you have a model with a really short memory, so it's been almost 10 years since the last market crash. So if you only look at the last 3, you're not really getting a really good picture about all these different regimes that the market may experience. So it's always a trade-off, and we always argue about it. And then we end up compromising by leaving it, a certain way in one model, certain way in the other. Yeah. So we include like the borrowing rate, and then the cost of leverage as well. So we have that baked in. Yeah, so that's why we do the Alfred, and what we end up doing is we end up using the diagonals. So like in the perfect scenario, we would in every refit use the data as of that refit, but that's very time consuming and very difficult in terms of like data. So we end up doing like the diagonals. So at every time we use like whatever data was announced. So we don't take any revisions, but we take the unrevised data as far back as we can. Okay, I think I answered all the questions.
Yeah. Okay, thank you.